Today, the central bank v bond market tussle. Hello again, it's Martin North from Digital Finance Analytics, World Notice Posts, covering finance and property news with a distinctively Australian flavour. Today I'm joined by Damien Klassen from Nucleus Wealth. Hi Damien, how are you going?
Hi Martin.
Great to have you on the show. Very interesting developments over the last few days where effectively we saw the markets really testing the Fed's resolve and I guess the Reserve Bank Australia's resolve with regard to their 3-year bond target.
Yeah, absolutely. It's been central banks around the world have been sort of making comments on it, and I guess there's a question about how fast bond yields are rising. Certainly, they've lifted off significantly in most countries, and the long end of the bond is really where the market tends to have a lot more control over the short end than the short end. The short end tends to be pretty well anchored by central banks, and the question now is how high does it need to go before central banks really will step in and start trying to push it back down again. The RBA gave us a little bit earlier on in the week in terms of doubling their purchases, but as you said, it's a key issue in terms of trying to work out where market's going to go over the next sort of 6 to 12 months.
Yeah, and reading the ruins, it seems to me that probably there was some central bank coordinated discussions over the weekend in terms of the level of support. The Fed Reserve basically did some. The RBA did a lot.
Yes.
Thursday, Friday and Monday, and they've announced a bigger program than previously expected. And it's interesting that if you look at the trends on the charts yesterday, the rates were lower until after the Reserve Bank released their notes, and then the 10-year shot up again.
So, yeah, exactly. So I think there was so I think what the RBA did certainly affected markets right around the world in terms of, I guess, market participants waking up and going, okay, well, we were pushing central banks to see how far they would go, and it looks like we're reaching a limit. Maybe other central banks will step in and start doing things. That didn't really happen as much. A little bit of lip service to it, but there wasn't really a lot of strong words from central banks. And I think markets were probably looking for the RBA to come out and just explicitly talk a little bit more about that long end of the curve, and that it wasn't going to let the long end get away. So I think that there was a little bit of language around that, but obviously the announcement of doubling their purchases made a big difference. But I think their markets were probably expecting a bit more follow through, and so without that follow through, we're expecting to still see that long end of the bond end keep rising. And it's important to keep in note, I think I spoke to you last time about this, was the idea that inflation we're going to print some really high inflation numbers over the next 6 to 12 months. A lot of that's just on a low base effect, but there's also a whole host of other factors that are coming through, and short-term sort of cyclical things that are hitting the market all at the same time. We could easily see some 3 and 4% inflation prints, and at that stage, long bonds at 1.5% seem mispriced. If you've got an expectation that those that inflation is going to keep on. Now we don't, but there's been a lot of people out there for a long time saying that central bank printing is going to lead to inflation, and that kept unchecked, it's going to lead to hyperinflation, and there's a whole thought process that sort of starts with inflation's here, and then it's about to get out of control, and those people the people that are sort of espousing those views haven't been successful for the last 10 years with that. But now they're going to get this moment in the sunshine where they're going to be on the front pages of business newses, and they're going to be on CNNs and CNBCs and things like that, talking about their views about how inflation is going to get out of control. And so that's where I think a lot of this is coming from. Is that that's where we're going to see the long bond keep on rising.
Very interesting. And of course, the Reserve Bank did mention that there might be a little blip in inflation because of the withdrawal of stimulus measures and things. They actually made that comment yesterday, which I thought was quite interesting. I do see this really interesting contention between those who, frankly, are gold bugs or whatever, saying, well, if inflation's coming, then we need to be in metals, etc., right? Whereas some others who are saying, no, you're misreading it, right? Actually, despite all the hype, despite everybody's fixation on inflation, actually the deflationary impact of low interest rates, the quantitative easing, and the fact that the real volume of credit that's being created isn't flowing into the real economy could actually be deflationary.
Yeah, so I think the way I'd characterize is there's a lot of very short-term inflationary forces, and in the longer term, we've still got the deflationary forces. Now, it could be that we get central banks and governments spending more and more money, and so let's say Biden gets his $15 minimum wage up in the US. There's a $1.9 trillion stimulus from him. He follows that up shortly afterwards by more trillions of dollars via infrastructure spending and all these other factors. You could see where keep adding to these, you can get to the stage where you can get inflation. But I think that's a relatively long bow to draw at the moment, to say that all this stuff's going to sail through, and he's got effectively no majority at all. He's got all he has to do is lose one Democratic vote, and he can't get it through. And in terms of the some of the factors might need to go through the filibuster, and so there's a whole bunch of issues as to why unfettered spending is unlikely, but it's not impossible, I suppose. So I guess we're looking upon this as saying we think markets are going to be pricing in this inflation, and it's one thing for central banks to say we're going to keep rates low, for an extended period of time, for 2 or 3 years, when inflation is already very low. But in 6 months' time, when the RBA gets asked, we're printing 3.5% inflation, and the RBA gets asked, well, if inflation levels stay at this level, are you going to raise rates? They'll be like, well, yeah, I guess we will. If inflation rates, we don't think it will, but if inflation stays where it is, and people tend to have this anchoring where whatever the latest inflation numbers are is what they'll tie themselves back to, and so that's where we're sort of expecting that it's going to. I expect the noise around this inflation is going to only grow for the next 6 months, or longer, until we start seeing when that starts fading off, and those deflationary forces we've spoken about, which are sort of entrenched, in my view, in most of the economy, that they'll finally start to work through.
So for me, I think, Damien, the touchstone is going to be wages growth, right? In Australia, There's been no real wages growth since 2012 for most people, inflation adjusted. And the Reserve Bank, of course, in its comments yesterday said, look, wages growth won't happen for a long time because unemployment's too high. And we're seeing those same trends in other countries around the world too.
You spoke about the high unemployment rate, which is obviously affecting it. The other big factor is the work from home. So we've just all of a sudden unleashed on all these companies that just thought, we can't have people working from home. Now we're going, well, you know what? Actually, we can have people working from home. And if we've got people working from home, then maybe we can get people working from cheaper cities and paying them a bit less, or cheaper countries. And so that wages growth, we were already struggling with wages growth before the crisis happened. And now we've just suddenly opened up so that companies can find cheaper workers elsewhere.
So the virtualization, which was already happening, absolutely accelerated. And I've had several conversations recently with people who've moved to cheaper areas and are still just doing what they were doing, but not actually expecting to be paid more, in fact, paid less, because the cost of living are less.
Yes, yeah, exactly. They've given themselves a pay rise effectively, or a net pay rise in terms of, if you think about their revenues coming in versus their costs. And so they're not as likely to turn up to their boss to say, no, I need a 5% pay rise, or I need, And I have to harp back. I'm sure I've spoken about this on your show before, but the RBA itself went through a negotiation last year with its own employees and only gave them I think it was a 2% pay rise or something like that. And the government's out there capping public servants' wages. And so, the two places that probably could and should sort of lead the way, are out there saying, no, we need austerity and we need to keep wage growth low. And then turning around and saying, why can't we get any wage growth? And so, yeah, I think you're on the path there. So, yes.
And interestingly, the public sector, which always had stronger wages growth, if you look at the most recent statistics, that's wilting. And of course, private sector wages growth has always been very, very weak. And let me just touch on the automation side, because I think that's the other factor that people probably haven't sort of fully thought through. But ahead, we're going to see more and more types of jobs effectively being automated away. And so the whole question of supply of jobs, demand for jobs, type of jobs, I think is, in other words, job mix, I think is the other big question.
Yeah, absolutely. And so, I mean, this is obviously a long-term trend that's just going to keep chipping away. But I think most of the sort of economic studies that look at when you get dislocations like a pandemic or wars or other things that force people to do something differently end up actually being quite productive in the end, because people have to do things differently, and so they change what they're doing, and then they work out different ways to do it more productively. And whether it be I think there's some talk about onshoring, so taking production processes out of China and roboticizing them and putting them either in the US or Australia or Europe, wherever, much closer to the customers. And robots don't need a pay rise every year. They actually, generally speaking, they need a pay cut every year. It gets cheaper to produce and more effective and more efficient. And so, so those sort of factors, as you said, are just an inexorable sort of drive lower. And we're going to get a bit of a deflationary push from those as they start to come in.
Mm-hmm.
Sorry, actually, having said that, though, there's probably a short term, while you're setting up, there's probably a little bit of inflation. One more of these short term cyclical factors, that's as you need to move, you need more people to set up the factories and do the processes. And those people are probably quite highly paid and can probably demand a little bit more wages because the need. But once they're in, then the costs sort of drop away quite dramatically.
And I had two other questions which sort of spin off the back of that. The first is, how do we measure inflation in the first place, right? Because there's a big debate about whether we're measuring it right or not. And some would claim that the real inflation in the real economy is different from the official figures. Does that factor in, or does everybody just go by the real figures?
Yeah, look, it's difficult. We sort of break things down in a number of different ways. But one of the key things that I feel has been a factor over the last 10 years in particular is it's an inflation in things we want versus things we need. So when you go back to, an example is the inflation on fruit and vegetables has been relatively significant. We've had deflation in ice cream, and you sort of go, well, there's one I'd like to have, but the other one I need to have as an ongoing. You look at healthcare and versus buying flat screen TVs or computers or just all these things about the products that are infrequently bought, say washing machines and toasters and other things that have got that deflation sort of built in. And so people don't notice those as much because we don't notice that, okay, I paid whatever, $800 for a fridge, and 10 years ago I paid about the same price for it, and so it's basically gone nowhere, and so you haven't really noticed that. Whereas out buying meat and vegetables, or paying your school fees, or paying for your health premiums, that is being noticed every day, and they're the ones you can't avoid. Whereas some of the ones where we have seen a lot of deflation is about saying, well, do I really need a TV this year, or can I hold off for another year or another 2 years? And often the answer is yes. Whereas the question about, can I hold off on this medical expense, or can I hold off on this, education expense, is the answer is no, because they're the ones which we're spending. And I think that's what gives people that impression, that inflation is higher than what's being reflected in the numbers. And so, yeah, but it is I guess, there's a lot of question marks about how it's put together. And for me though, the point you made right at the start is the most important one, and what central banks, I think, are looking at in a lot more detail than they used to, which is that wage inflation is the key. if where you have inflation is where wages get out of control, and wages are going up, which means inflation goes up, which therefore wages need to go up again, and you get caught in that spiral. Whereas there's other factors where, if oil shoots up in price in the short term, more production comes on, and then that leads to lower prices, and so that's not something that policymakers should be as concerned about, or a hurricane goes through and wipes out our banana crop, and all of a sudden banana prices shoot up, is actually saying, well, that's not a long-term problem. We know there'll be a new growing season. We know people are going to probably even plant more, and we'll actually end up with lower prices, in 2 or 3 years after. And so, I think the policy making is quite aware of that, but that's what you miss on the ground level, I suppose.
And of course, the other interesting observation is that the house price growth doesn't translate through to CPI, right? So there's a rental proxy that's used. The rental proxy is more reflecting where rents are, and rents aren't necessarily increasing. So, CPI is insulated from house price movements.
Yeah, exactly. And and there's obviously lots of debate about what the right way to do it is. But it is certainly something we need to keep in mind as we're putting these together, is to that's one factor that obviously makes people feel as if they're getting further and further behind if they just can't save enough to get their 20% deposit or whatever, because the house prices keep going up, and so the amount needed to save keeps going up.
And last question for today, Damien, with regard to that sort of context then of inflation, short term, the bond issues, how's that changing your thinking with regard to portfolio allocation in the funds?
Yeah, so for us, we're in any of the bonds we own for some time now, we've been at the shorter end of it. So in the sort of 2 year and 3 and 4 year bonds that the RBA has got sort of pinned and has a lot more control over, rather than the long end of the bonds, we're expecting an inflation scare, and there will be a time to take advantage of that. Having said that, we need to be cognizant, though, of, I said it was unlikely, but it's still possible that we do start getting such great government stimulus, such a great amount of government stimulus, that we do actually get genuine inflation. So at the moment, we're sort of playing it as we think there's going to be an opportunity in the next 6 months to flip back and to pick up some more bonds, and especially some more bonds at the long end. But we're not so certain that's going to happen that we feel like we should be out there doing it today. We do think there's scope for bond yields to go higher before we start seeing a return.
And presumably the extra stimulus that the Fed may or may not do, and all the quantitative easing, well, that will tend to support stock prices too, won't it?
Absolutely. So, and within the stocks as well, it does make an issue for, we've got a lot more value stocks than what we had, say, 6 months ago. And they tend to be the stocks that will perform well as inflation rises, or perform better than the growth stocks. And day by day it changes, but certainly last night we saw a lot of the growth stocks hit once again. And that's that with the rising bond yields, you do tend to see some of the growth stocks are going to suffer more. But if we're right, and that deflation we are going to return to a deflationary environment after a year of inflation, then there's going to be a time to start picking up some of those growth stocks at relatively cheap levels. So for us, it's about having the bonds are a bit easier. We've got a list of the bonds we want to buy, but also having a list of those growth stocks that we quite like and we'd like to see more of in our portfolio. But we think there's going to be some opportunities popping up over the next 6 to 12 months to start rotating in and picking those up at cheaper prices.
Excellent. Well, Damien, I appreciate your time today. And just to say, of course, the Water the World Fund, Water the World Super, is managed by you guys. And we'll put some links and things below if people want more market exposure. Nucleus Wealth is the way to go through those funds. We're going to have another chat a couple of weeks down the track on a live show, but I thought it was really good to get an update today because of everything that's going on. I appreciate your time.
Thank you very much. We'll speak soon.
See you soon. Take care.